Welcome to another in the series of EPRA Mythbuster interviews. Today we're going to be looking at one of the more frequently repeated myths, that real estate is better owned directly than through listed securities. Michael, you and your colleagues at Duff and Phelps Investment Management feel differently, so why is this?
Well, to start with, there's solid evidence that suggests the addition of real estate to an investor's portfolio can offer better risk-adjusted returns. There's a growing volume of research which confirms this performance can be achieved through listed real estate as effectively as direct real estate over the mid to long term. And we believe for many investors there are a number of benefits that favors achieving this allocation through the listed space.
And you mentioned benefits there, Michael. What are some of those benefits, particularly for a listed real estate investor?
At Duff and Phelps, we believe there are 5 important benefits to investing in real estate through the listed space. Listed real estate comes with an integrated and aligned platform, environmental, social, and governance benefits, liquidity, transparency, and diversification.
So let's start with the first of those, the benefit of an integrated platform. So what exactly do you mean by that, Michael?
Well, the days of being a passive absentee owner of real estate are long gone. Now more than ever, it's important to have an expert team that's tasked with delivering the product and services, ever-changing tenant-based demands. Thankfully, the large investment in people and systems has already been put in place by listed real estate enterprise, and this gives investors instant access to a pool of seasoned professionals that are experts in their asset class and local markets. For investors in listed real estate, the decision to change that portfolio allocation either by geography or asset class can be made relatively effortlessly, while a direct investor would have to incur delays in execution and most likely incur social costs related to changing or reallocating the staff required by that decision.
And you mentioned ESG. So how would an investor better achieve their ESG goals through listed securities?
Well, to start with, I think we can all agree on the importance of the pursuit of higher ESG standards given the contribution the sector makes both to greenhouse gas emissions and as an employer in any economy. However, we believe doing the right thing can also deliver better risk-adjusted returns. Reducing the consumption of energy and water and increasing the amount of waste that's recycled has a clear fiduciary benefit and is in alignment with tenant requirements and ensures the competitive positioning of any asset. A real estate company investing in its people and making a positive social contribution to the market it serves should encounter less obstruction when seeking approvals for developments that further those objectives. And having management and a board aligned with shareholders increases governance and can lead to even greater valuations of listed real estate. For the typical direct real estate investor, the implementation of an ESG plan brings with it an even greater requirement for human resources. And we believe there are economics of scales in this matter, which I think underscores my first point even more. For those considering an investment in real estate through a private fund, it's true that some private funds have more recently adopted lofty ESG goals. However, the added benefit of listed real estate is that through engagement with both the board and senior management of a listed real estate company, concerned investors have a much greater say in the operation of the portfolio. Should management not be responsive either to the ESG or other operational issues, a listed real estate investor can take up to 4 steps. 1, they can elect to engage further. 2, place or join a proposal for change on a proxy for other investors to vote on. 3, you can vote against board, and 4, you can sell the position through an exchange that's limited only by market demand, not by fund restrictions. None of these actions can be replicated through a private real estate fund.
And you mentioned liquidity. Why would this aspect be a specific benefit in terms of the listed real estate side?
Well, as direct investors will tell you, high quality portfolios aren't always available in the market. In the listed space, high quality portfolios of assets are available for sale every day. For those that try to buy directly or through private real estate fund, there could be a considerable delay from the moment a commitment is made to an investment until it's finalized. More importantly for investors, should portfolio rebalancing require the partial sale of an investment, this is much easier to achieve through the sale of shares on a public exchange, rather than selling a partial interest in a whole building. For private fund investors, there may be restrictions on annual redemptions, and in more uncertain times there may even be a halt to redemptions altogether, which clearly would not be good for any investor seeking to raise cash.
And in terms of transparency, why do you see the listed sector as being more transparent?
Listed real estate companies, especially those that have adopted the best practices from organizations such as EPRA, provide public audited accounts and earnings reports that can be reviewed by a wider number of market participants and stakeholders compared to alternative investments. Not only do listed investors benefit from this wider scrutiny of results, but the consistent presentation of those results allow investors to better compare these results to alternative investments and, importantly, to aggregate those results across a larger portfolio of equities, bonds, and in particularly in the area of ESG reporting. Moreover, annual reporting and prospectuses for listed securities clearly disclose management, pay, and any potential conflict of interest that would be important for investors to evaluate management's performance and alignment of interests, something that is not readily available for the fund investor.
And the final benefit was diversification that you mentioned there. Why do you think that listed investors are able to perform better in this particular area?
Well, investing in a listed security, or even better, a portfolio of listed securities, gives the investor exposure to a much greater number of asset classes and geographies that could provide the exposure to a more diverse economic and property cycles than most individual investors could achieve on their own. To achieve an appropriate level of diversification for a fund investor that seeks exposure across a range of geographies, investment strategies, and sectors, including non-core sectors, might require investment in a number of different funds. Having multiple fund investments means reduced economies of scales at the fee level for the investor and is more management intensive.
Really interesting to get your thoughts, Michael. I guess it would be interesting just to get your sort of key takeaways, particularly for investors looking to invest in this space.
We at Duff & Phelps believe the key reasons supporting an investor's decision to invest in real estate through the direct listed space would be the benefit of an integrated and aligned platform of experts, the ability to identify, achieve, and benefit from ESG goals, and the wonderful attributes of daily liquidity, transparency, and diversification.
Thanks very much.
Thank you.